Srivastava, Managing Director at Dimensions Corporate Financial Services. Ajay, always great speaking with you. Let me first start off and try and get your view with regard to where we sit at currently, where the Nifty is concerned. Q3 numbers have obviously now majorly trickled through. Numbers largely have tilted on the positive front. We've started to see margin uptake. Of course, profitability has not really ticked upwards because of the one-off on the labor code adjustment, but growth has also come back to a certain extent. How are you assessing the numbers, and how do you see valuations broadly versus the numbers that have come?
Good morning, Hitesh. No, I think, you asked the market, are we comfortable? Yes, of course, we are quite comfortable with the market because two things have happened. The excesses always go out of the system. You're more comfortable. I think the biggest trigger in India has been the FI. I think we're just seeing the slivers of coming in. So technically, the market is set up nicely, very cleanly. The corrections have taken place, and the good stocks are doing extremely well. And so all in all, are very constructive. The results, it's a mixed bag. People have done well. Some have done well. Some have done not so well. But people have done well, really coming from where protection has been given to them. Those industries have done well. Other industries, we are the same old. Nothing changed with it. That's the best part of India is that the more we try to change, the more we remain the same. Still, you have the banks, the auto companies, the stock exchanges delivering fantastic results. So nothing really has changed. The key thing is that, the only thing is that the volatility in performance of most companies has gone up. Earlier, you could have a good predicted path to profitability or performance. Now, you have sudden surprises coming across the board from various companies. All it tells us is that, listen, good times are meant to be milked, and therefore you sit with the cash for the bad times.
We've had a few rough times, Ajay. Hi, morning, firstly.
Good
Definitely
morning,
all through last year, and especially what a hectic January and start of February as well it's been. Have you been deploying that cash is the question.
Aisha, actually last year has been one of the good years. It's been an extremely good year because two things happened. Select equities did extremely well. There's no problem with the stocks. Most of the stocks did extremely well. And then the bonanza from the silver and gold. So I think most investors actually would be closing out 2025 quite well compared to just the stock market, because we focus on stock market, but we focus on international stocks, gold, silver, and Indian stocks. Therefore, by and large, 2025 has been extremely good. It's been 2026, the sucker punch which came and hit us. And I think that's where the problem comes and the challenge comes. So I think, coming out of an excellent 2025, which is strange for people to hear, but the fact is, it's been brilliant, absolutely. 2026 is going to be challenging. And the most important part is that this has to be a very stock selective market, and that continues to be the theme at the end of the day. And we still don't know what's going to happen to the US trade deal because everybody's got a view. We have got optimism on one side. We don't know who the losers are at the end of the day. We don't know who's going to pay for the oil at the end of the day. So I think euphoria for shrimp exporters, gems and jewelry is fine. But in a broader context of the economy, let's wait till the trade deal comes out and then we will know how 2026 shapes up. But I have no complaints in 2025, and I think most of our people we know and we work with have no complaints on 2025.
Okay, that's interesting to hear. Many have been cribbing about how much the mid and small cap portfolio has bled. But Ajay, what next for the year ahead, considering you think that this one's going to be challenging?
No, I think, we can't change the theme. You just saw the results of stock exchange coming out today. I think excellent results. You've seen what happened to commodity exchange. Super results came out and it's going to continue. I think select monopoly companies in this country are going to do very well. Stock exchange is the biggest sector, which is a pure monopoly, is going to do extremely well. Telecom does well in portion, but you got to be patient with it. I think it's reaching a point of good inflection, and if they move to data center, etc., I think you will have a good mix of them. So if you look at telecom, if you look at your stock exchanges, if you look at auto companies, fantastically doing well, performing well, exporting well. So I think these three sectors will continue to command. Whether consumer companies come back into reckoning, I do not know the answer to that one because the valuations are not crazy, absolutely. We are India values retail companies selling kapadas at a piece of God knows what kind of AI companies. So I'm not too sure about our retail companies at this point of time. How will they fare up in the year? But the sectors we did well last year, we should do well this year. Same goes for banks, autos, healthcare. It's just the same thing. I think as we get older, we realize nothing much changes in the world, does it?
What about IT, Ajay? Anything changes there?
Good question, my friend. Hitesh, good question, my friend. Unfortunately, no. And I think the reason is not because, I keep saying I blame this management. I think Indian IT companies have just had the dumbest management teams across the board. It's not one company, everybody. All they needed was dividend, dividend, dividend. They never thought to invest. And I think the day of reckoning has arrived. Rumblings are happening that, yeah, we will change and we will do this. But maybe it's late in the game. Luckily for Indian investors, we have the US market to invest at the end of the day. So I think anybody who wants to invest in tech, I would seriously suggest go to the US market and not an Indian market, because Indian market is such a small subset of services. You don't get the exposure. The ETFs of the US, etc., will do far better than Indian companies. I don't know the Indian companies very well by now because I don't track them, haven't bought them, I don't keep them for the last couple of years. Because what is the business proposition to the world today? Is zero absolute. They were body shopping into America. Once H&B disappeared, H1B disappeared, their body shopping is going to be a problem at the end of the day. So let's identify. They were pure body shopping shops. They were making good money from the H1B visas, and that's the right thing to say. I'm sorry to be unpatriotic, but that's what they did actually. And life has caught up with them. So whatever they can say, we were specialized and we are doing this and that, at the end of the day, that was the mainstay of income. So why waste your time here? You have opportunities. All Indians can invest abroad. Just go and invest in the place where technology is born and bred.
And Ajay, I wonder what you make of some of the ancillaries in terms of consumption. Stocks which haven't done as well, something like a QSR, for example. Now I know, again, maybe from a valuation standpoint there isn't comfort, but if the cycle could turn, these could well be very interesting names. Are you playing that theme at all?
Not at all, not at all, not at all. I think, again, I keep saying that the world has moved. And if it's, the themes, yeah, they may perform some year QSR. Somebody may announce a discount scheme on buy two pizzas for one. Somebody may give you burgers free. But at the end of the day, where is the traction? Where is their moat? Today, so many of those, what do you would call virtual kitchens, or what do you call them? They work in this. When I see my kids ordering, or when I see go to people's houses, people order from places we don't know about them. So I think the basic proposition is that fact that in a scale or size of India and the retail cost of India, these people don't survive. McDonald's does very well in America because the retail cost is so low. They're able to make money, whether it's Dunkin' Donuts or it's McDonald's. They do so well in America, very profitable. Our retail rentals cost, maintenance cost, power cost put together just kills this market. So India's QSR story is dying not because people don't want to buy, but the cost of servicing the customer through the retail outlets is outrageously high for them to make any money. So, so therefore we have stayed away from it. We still want to stay away from it. There's no path for them to be profitable long term, unlike an American model where retail costs are low, therefore people make money. Indian, try hiring a shop in a mall and you will die just paying the rental and your maintenance costs. So where is the question of making money? So I think stay away from QSR. It doesn't have a moat, at least Indian context, which gives you profitability in longer term framework.
Cloud kitchens, Ajay, you were close.
Oh, sorry. Okay,
Yes.
that's my old age. I should just you give me pardon my old age. I said cloud kitchen. Have you heard, Aisha, that today people are ordering food from places you never heard of?
Yeah. We all do that.
There we go. There we go. That answers the question about trying to order a pizza from Pizza Hut. You'll be, I think, socially boycotted, Hitesh, if you order a pizza from Pizza Hut on any party of yours.
Yes, he sure will. But other than that, Ajay, I mean, what about the entire Capex, manufacturing, EMS plays which have come to the fore so much more after the budget this time? Anything that's looking good there?
All are good except valuation. I hope they come down. You saw what happened to all the EMS companies. The valuation people, we just pick up a theme and start buying the stock as if they're going to be gold coming out of them. It's not the fault of the companies. Companies are good. It's just that the kind of pressure mutual funds had to buy, Aisha, they just built up into a nutcases of valuation. How do these companies justify those valuations? So all companies are good. Industrial companies, we have good companies, but all are above P's of 50s and 70s. Now, when government expenditure is growing Capex at 7%, India's private Capex is going in single digits. How do you justify Ps of 50 and 70 for the industrial companies? That's the dilemma, that's the problem. Companies are good, sector is very good. We need the power companies, we need the infrastructure companies. But at these valuations, if you buy as an investor, how do you make a return? And you've seen what happened. And the damage has been done in, you're talking about BC grade companies. I'm talking about biggest MNC companies. Look at their stocks, how they have been hammered in the last 1 year, only because we just build up the valuations. So let's divorce from the fact that good companies, bad valuations, make bad investment choices.
Perfect. Ajay, quick correction, it's Harsh.
Sorry.
Yeah, no worries. Ajay, just very quickly, with regard to banking, you suggested that that's a good play as well at this point. Where within banking are you currently placed, or where within the lending pack are you currently placed? NBFCs did very well in 2025. Do you continue to be bullish there? Is it the private lenders which haven't done much and re-rated downwards? Is it the PSUs which have re-rated upwards? How do you see that play?
See, the way we have divided our portfolio is almost 50% in gold loan companies. Two gold loan companies are 50% of our portfolio of the financial sector. 30% is companies, private banks, which have got equity infusion from various PE funds. And 20% is in PSUs. That's really all about it, banks. There's nothing in the large cap bank at this point of time because the movement is so slow. The returns, relative returns are going to be poor. And I'll tell you the reason why we are very quite bullish even on the banks at this stage. That India, as you saw, what's happened to the yield, the GY yields, they're going up. We are about to enter a cycle where they will be forced to raise interest rates, or the banks will say, I'm going to lend you at this rate, increase their margins on each of the loans, even if the repo rate remains the same. Effective cost of lending in this country, or borrowing, is going to go up this year. There is no choice. And banks make the best money when rates are going up. Obvious reasons that you can pass on the rate increase today, but your deposits are at the older rate will continue for next 5-7 years. Therefore, we are about to enter a 2-year cycle where interest rates are going to go up, and that's the best period for the banks. They will make tons of money because deposits are not being repriced. It's exactly the reverse of what happened last year, where the deposits had to be repriced and the loans had to be repriced lower faster, and they had an IM problem. It's going to be bountiful of money coming your way. Given the way the government of India and state governments are borrowing money, there is no way interest rates can remain where they are. The yields are already showing to you at the end of the day, the 10-year treasury yield is already showing to you where the bond market talks. And I think the biggest thing is for equity investors is keep looking at the bond market. Worldwide, it gives you the best signal what's going to happen to the equity markets. So in fact, I would say tend to believe that bond market investment, wait a while, they will be phenomenal, absolutely, because the interest rates are going to go up and going to go up quite sharply.
Okay, on that note, Ajay, thank you
Thank
for
you
your
very
time
much.
today. Good speaking with you. And you did talk about capital markets. So let me welcome on board the MD and CEO of Bombay Stock Exchange.